All right, let's talk about a number that tells you pretty much everything about a company's game plan. It's called retained earnings. And no, it's not just some boring accounting term. It's the fuel for growth, it's the reward for investors. Really, it's the clearest signal of what a company is all about. Let's dive in.
So think about it. A company has an awesome quarter, they make a ton of money. Then what? What actually happens to all that cash? Does it just get handed out to the owners? Does it sit in some giant bank vault? The answer? Well, it tells you everything you need to know about that company's strategy. Okay, so here's the deal. That profit, it gets split. Some of it might go out to shareholders, as dividends. But the rest of it, the money the company actually keeps, that's what we call retained earnings. You can think of it like this growing pile, a running total of every single dollar of profit the company has plowed back into itself since day one. It's their earned capital, so to speak.
All right, so how do we actually keep track of this earned capital? Well, it's not some big secret. There's a really clear standard formula that accountants use all over the world. So let's unpack exactly how this super important number gets calculated.
And there you have it. This is the core formula right out of the accounting playbook. We're talking GAAP or generally accepted accounting principles. And you know what? It's actually beautiful in its simplicity. You take the pile of earnings you already had, add in the new profit you just made, and then subtract whatever you gave back to the owners. Seriously, that's the whole thing.
Okay, let's walk through that. Step 1, you need your starting point, your beginning retained earnings. You're going to find this on the balance sheet from the last period. And hey, if it's a brand new company, that number's 0. Easy. Next, you add in your net income. That's your bottom line profit, right off the most recent income statement. And what if you had a loss? Well, then you subtract it. Finally, you take away any dividends you paid out to your shareholders. See? Simple as that.
Okay, so calculating the number, that's the easy part. But the real magic is understanding the story this number tells. This one little figure is a massive signal about a company's health, its priorities, basically its entire philosophy for how it's going to grow. The thing you really have to get is that this number is never static. It's always moving, always part of a cycle. This money is literally the fuel for the future. It gets poured back into R&D for the next big product. It's used to buy better equipment, or maybe even to snap up a competitor. It's also used to pay down debt. And all of that, it creates value for the shareholders, which signals a healthy company, which in turn attracts more investment. You see how it all connects? A steadily growing balance of retained earnings is a fantastic sign of a healthy, self-sustaining engine. And this right here perfectly shows the two main schools of thought. On one side, you've got your growth company. Think of a tech startup. They're probably going to keep nearly 100% of their earnings to pour right back into the business. They're screaming, hey, the best place for this money is right here, funding our future growth. But then on the other side, you've got your value company, like a big, stable utility company. They're more likely to pay out most of their earnings as dividends. Their signal is all about stability and rewarding investors with cold, hard cash right now.
All right, let's bring this out of theory and into the real world. But before we jump into a couple of examples, we absolutely have to clear up the single biggest misunderstanding people have about retained earnings.
Okay, listen up, because this is super important. Retained earnings is not a pile of cash sitting in a bank account. I'll say it again, it's not cash. That money has already been spent. It's been reinvested. It could be tied up in a new factory, or the inventory sitting on the warehouse shelves, or in some fancy new piece of equipment. The retained earnings account on the balance sheet is just an accounting entry. It tells you the source of the money that was used to buy all that stuff.
This is awesome. Look how the exact same simple formula tells two totally different stories. Over here on the left, you've got the startup. They made $150 grand, and they kept every single cent. A 100% retention ratio. That is pure, unadulterated reinvestment for growth. Now look at the mature utility company on the right. They made $400,000, but look, they paid out most of it, only keeping about 12.5%. Their focus clearly isn't on explosive growth, it's about giving back to their shareholders today.
So, who actually cares about this number? Well, turns out pretty much everyone, but for different reasons. An investor, for example, is looking at that trend over 5 or 10 years. They see a compounding machine, right? A business that's a master at turning today's profits into tomorrow's growth. But a lender, they see something totally different. They see a safety net. That big balance means the company can handle a storm, a couple of bad quarters, without going under. It's a financial cushion. Okay, so we've gone through the formula, we've talked strategy. What's the one big thing you should walk away with? Let's bring it all home. Here's the key takeaway. Retained earnings are like the historical record of a company's success, written in the language of accounting. It doesn't just show how much profit a company has made over the years. More importantly, it shows how much it has believed in itself enough to reinvest for a bigger future. So now that you know the formula, go look up your favorite company. What story are its numbers telling you?